And then for operating expenses, Andrew went through it. You've got a detail, you've got a historical base, you've got your knowledge, right? We'll talk about that in the afternoon. We're going to spend some time. I sent you some things. We're going to spend some time doing something this afternoon. Okay? And then ultimately, there's an inflation factor that will most likely impact those expenses. And you need to tell Argus what you're going to grow those expenses at. Make sense? I'll send you guys, what I'm going to do is I'm going to send you guys target sheets that we used to use for both stabilized assets as well as for development. Because when you're doing ground-up development, not only do you ultimately get to all of these income stream items, you have a bunch of site work and development costs that you need. So I will send you for both stabilized buildings and for development models a target sheet, so at least you know the inputs that you need to have when you're going to model going forward. Okay? Andrew, I didn't mean to.
No. Take your time. Go. Alright, this is basically where you enter in expenses. We've already gone through that. I'm not going to really elaborate. And then here I can easily put my inflation for expenses, CPI, my market rent, general vacancy. We ran this at 5. What the professor was talking about. Was that on the whole time or no?
Yeah, it was on.
Okay. Collection loss, we did none. Now, any other questions before we start to?
Just one very quickly.
Yeah.
What's the I guess the reasoning behind putting the revenue per square foot for tenants? I mean, is there any real, like, this store here, they're smaller but they're cranking it out, they're doing well, versus this one? Is there any real reasoning behind including that in an offer memorandum or talking about it, or is it just?
No, it is. I mean, it's a huge, because you want to see what their ratio is.
Right.
Is it 25%? Is it 10%? A lot of stores, I think the magic number on retail is what, 10%? 10 to 20 max of rent versus income.
Right.
So that's a huge thing, because if somebody's paying rent that's half of their income, you know that they're probably not going to survive. On the larger tenants, I know when Dixie's, Publix's like to be at that 3 to 5%, which is why sales per foot on a grocery anchored deal is huge.
Yeah, look, to that point, we kind of talked about every business has a sales number, right? And it has a series of SG&A expenses, right? Occupancy is one of those. The more sophisticated businesses, the more national businesses, the more established businesses have a damn good idea of what their business operating model is, right? So they ultimately, based upon what this number is, can back into what they can afford to pay for occupancy to get to their anticipated return model. So just in the retail space, I can tell you that deal that when I first met Eric, that we bought the trade zone, we were carrying an extra 13, 14 acres. Frontage on a great street in Doral, very nice demographics. So who wanted to be in the market? Target, Home Depot, Lowe's. Walmart was already closed, so they didn't want to be there. What was the problem with those 3 large guys? They fit in our footprint. They couldn't pay what we needed to sell the land for to make it worthwhile for us to sell. Because ultimately what they knew they were going to generate ultimately was working back to an occupancy cost that was going to be, and in this case we're talking about outright selling the land to them, but it was like, I don't know, $13 a square foot. And we needed to sell that land at 17 to 20 to make it worthwhile. So there was a tenant in the market, there was a need in the market, but it didn't work for us. And it didn't work for them, because they couldn't pay that, and come back to that number. And you can do that with the out parcels too, And And each one of these stores has a different model, right? McDonald's can pay more for land than Burger King, because an average McDonald's does, I don't know, $1.7 million, and an average Burger King does $1 million a year. So if you do $1 million a year in the food and beverage business, it's very structured and very standardized, and it's all X number of employees, and there's what they sell you the food for. You can pay X for occupancy. And ultimately that works back to a rent per square foot or a dollar per square foot that you buy if you're going to develop the asset. The more you can sell in a location, the more you can afford to pay for occupancy.
And with that said, so we know Office Depot sales are at 5.5, or call it 5.7, right? So 5.7 on 25,870 square feet. They're at 220 of foot, which, God bless, 744 divided by 220. So they're at an occupancy cost of 3%. So I mean, they're basically paying nothing out of be there. So with that said, them being so low, it might be 10 times harder for me to convince them out to leave. Any other questions on market, how we got the rents, or anything else before we go into valuation? No? Alright, so I'll use this to export the cash flows into my model, if I could find it here. So using that, I'll then export it into this right here, which is all of the cash flows monthly from the Argus, which then ties into certain tabs for the cash flow yearly and monthly. Now with this, I then create a summary page, which I'll give my partners, the banks, the funds, to sort of give a quick overview of what the asset is. So I mean, real quick, it shows, make it bigger. So real quick, it shows what the asset is, 106,000 feet, top tenants are boom, boom, boom. Shows my uses and sources, assumptions. These are assumptions for another deal, but I just want to leave them in there to show you. And then it also gives me everything in blue is everything that I can change and easily manipulate, and then in return gives me all of my sensitivities. But actually, before this, I usually, when you're dealing with CB will give you a deck quote. This is one of the deck quotes that we got from them. Because it's just easier, we chose it would probably be best to do a non-recourse bank loan, 65% LTV at a fixed rate at 3.9. We thought we could do a little bit better on the IO at 24 months on a 30-year AM. So with that, I'll then put it into my my model. 65%. I'm not funding any TIs or LCs or anything else. We don't have to worry about that. And then my interest rate, term, and then my amortization. And then from that, I can say, okay, if I paid $29 million, it'll leave me with here's my return summary, if it'll show up. And everything here is that I want to see is here. And remember, this is...
Blow that up, please.
What was that?
Can you blow that up, Andrew?
Yeah.
More. There's old age back here.
So with that, it'll show me my return summary as a whole. So it won't show, I mean, depending on who this goes to, this return summary will be different. If it's going to the banks, I'll leave it unlevered only. If it's going to my partners, it'll have the JV returns as a whole, but then also ours. If it's going to the partner, it'll have the JVs and theirs. So every model is kind of,
What's the holding period then, Andrew?
this I use 10 years, but the key is I leave it at 10 because I could then use this to sort of see, you know, what's my, in year 10, I'm making a 3x at a 15, or if I do 5 years, I'm at a 14.5 at 8. And I could easily change this to, say, 5, which then impacts everything else. And then the other thing is, depending on what kind of fund you're dealing with, a lot of them want this right here. So what's my yield every year? This yield would be, call it 10.5 and 10 for the first 2 years. Once the IO expires, you're at an 8 to a 9.
IO is interest only for those of you who don't know.
Yes. And then this deal sold for what, 32,250? And based on the base case underwriting, assuming lower rents, assuming that the current tenant Office Depot stayed, your return on a 10-year is a 12 and a 2.42 on a 10-year hold, which seems low, but for a fund that bought this, I guess it's a bit below average, but I think they believe on it and the upside on what's going to happen with Office Depot, and another 2 years, can you vacate them?
Well, what cap rate did it close at?
Well, that's,
So that's, so, so this shows the cap rate. So this is year 1 cap rate at a 5.9 on my in place income.
Okay.
Alex, when you guys look at deals, what do you guys look at? IRR?
IRR, going cap rate.
Yeah. Yeah, a lot of institutions like multiplier, some don't.
Yeah.
We never used it. In the traditional middle markets, you know, sort of private equity realm, multiplier is huge. If you go outside of real estate, people never talk about, you know, sort of, IRR. Some people go in, they won't say cap rate, but, you know, they'll talk about an EBITDA multiple, sort of same thing, right? It's the inverse. But multiplier is huge. In 3 years, it's a 2x or 1x. In real estate, I find very few people use it. That's why I thought it was kind of interesting.
I know
But some people use it.
we use it because on a typical deal, we like to double our money. A lot of the funds like the IRR,
Yeah.
because they're
My experience is IRR because it gives you the overall return of the project, and going at cap because it gives you a relative valuation for today.
yes.
You know, those are the sort of 2 key metrics that can flow from all of, you know, the work that Andrew has done. This is kind of relative. I mean, that's, you know, but some people like it, you know, the multiplier. Yeah, Alex.
We use the multiplier when we're presenting to a potential partner on a deal that we've owned, say, for 10 years. when you spread it out, your IRR starts going down, so.
Yeah.
So, right, make it look, yeah.
So you have to show it another way and say, well, we've held this for 10 years, but we've made 3 or 4 times our money.
What, you know, talking about different people using different things, Eric was talking about the Fortress people. When Fortress bought FECI, they got rid of the real estate guys right away, which, you know, that's like when for me, problems started. They started saying they don't care about going in cap. They didn't care about IRR, but if we were gonna show them IRR, they wanted to see IRRs in like 2 to 3 year periods, saying, dude, that's not like the right time frame for real estate, you know? Real estate is a longer term asset, but they were huge in multiplier, and they talked about ROE. And I'd never seen anybody in real estate ever talk about ROE. It's a valid measure. We never talked about it, you know, but they were coming from a more, you know, alternative asset, hedge fund type mentality, and so those were the metrics they used.
Yeah.
Yeah, Nikolai, you had a question?
No.
I'm sorry.
And it's funny because we just did a deal with Fortress about a year ago now. And they were not concerned about multiples, but IRRs. And I'm fighting with them now because in the short term, there's a IRR that's some huge, ridiculous amount, but the multiple's lower than what we want. But because it's such a short term, they want to turn around, sell it, and that way they could tell their investors, oh, hey, look, we have this 110% IRR, and we're like,
It's $3.
yeah, exactly. So that's what I'm dealing with now. Any other questions on modeling, on how you come up with valuations?
Yeah, so,
Market analysis.
why don't you talk to people, so you did buy the deal, but you bought the deal, and you bought it at $32,250. So how'd you get to that number?
If it was us buying it, we were probably at just around 30. I think personally it's a bit too much, but they stepped in and wanted to pay this
Okay, but
huge amount.
let's, because I think it's a good time to talk about the process. So you gave us great insight. You and I must have taught you well, thought that's too high a price. I agree with you, that's definitely too high a price. But somebody else paid it. But, so there's 2 components. One, you ultimately have to get to a price, and that price is where you're comfortable with all the different metrics. Whether you're using IRR, going in cap, whether you're using multiplier, whether you're using ROE, you ultimately come up with a value. But there's a process, right? So the broker, CBRE, is running this auction. What do they say to you?
Bids are due Thursday, December 5th. And then, okay, great.
And if you know the broker, he might whisper something, right?
He'll whisper, or we'll say, okay, we'll do it December 5th, but at 7 p.m. after all of the offers are in, and then we'll sort of
And you'll play that way. So then you'll get another call, right? And
Yes.
say, you're final.
best and final.
Yeah. Well, that number didn't mean anything. Hey, lucky you get to pay more for it.
Which always happens.
It always happens, there's always the best and final. So then at that point, there's more whispering and more indications, and to the extent that you're better positioned, you might get more insight than others, and you might get more time than others.
Yes.
Okay, so then,
But the other thing too is the amount is great, but it also speaks terms. So are you going hard that day one, meaning that if you put up $1 million and you back out, that $1 million is theirs. No matter what happens. I mean, you have title exceptions and stuff like that.
They want to know, a lot of times, they will tell you, in that, especially in that best and final phase, they will give you a copy of the contract they're willing to sign and ask you to mark it up and say, what are you marking up in this contract? And as we spoke about in an earlier class, we're gonna get into issues over, they're not gonna wanna make any representations whatsoever. And you're gonna want all the representations, okay? So, you know, there's language there. How much time do you need to close, okay, is gonna be the next thing, and how much money are you gonna put off? And then typically what's gonna happen is those three guys are also gonna get a phone interview. And the other thing that's gonna be important is, what's your source of funds? So, who's your partner? Can we talk to your partner? What fund is it? What's your approval process? Who am I talking to? Do you have the authority? Has this gone to committee? Oh, this is a 1031. What certainty do we know that, you know, the funds are gonna come out? Well, I mean, so they will use that interview to then further steer. Because ultimately, most people don't have the fiduciary responsibility to sell to the ultimately highest bidder if they perceive that there are stumbling blocks closing.
Yeah.
So,
I mean, when I was on the brokerage side, my goal was how comfortable I felt with the buyer closing. I mean, there's been tons of times when somebody has offered $1 million, $2 million more, but I know that they're not real guys, and will they fall on their face? Or will they come back in 2 weeks and say, hey, look, I need a reduction of $1 million or to extend due diligence or whatever else it is. It also speaks a lot who you are, who your partners are. You know, if you're some random one-off guy, are you probably going to get the deal? Probably not. Unless you make us feel comfortable that you're going to close and you have money hard at day one with the 15-day due diligence.
I don't know what the particulars of this deal is, and I drew sort of a hypothetical. A deal like this is likely going to go to 30 to 50, you know, potential bidders. It all depends on who the broker is and how long they want the process to be, etc. Of those 30, now, and maybe you know the particulars on this deal, maybe you don't. But probably out of those 30, because those are usually qualified buyers, you're going to have as many as 20 of those ultimately bid. And because people know the market, and because everybody's cost of capital is similar, CB's already saying, hey, we got indication financing, and by the way, we'll do it for you for a fee if you want, but they're kind of already saying, hey, you can get this financing. We've already done the idiot, you know, the groundwork for you, okay? My guess would be that the profile on this is, maybe one guy bid as high as 32 because he really wanted it, not steal it. 12 guys were probably between 29 to 31 million bucks. And there were, you know, 2 to 8 guys that were just didn't get it or didn't really want it or were trying to steal it or wanted to save face and put a bid in, but they didn't really want it.
Mm-hmm.
And then what they're going to do is get this guy and use him as a stalking horse. They're going to say, hey, to the owner, hey, we told you we could get this. So they're going to pick their 2 to 3 friends here and say, hey, guess what? You can come back. You've been invited. But by the way, you're the worst guy. You know, it's like, you know how to buy something, right? You get 3 vendors and you get the cheapest one and you go, I really want to give you the order, but you're the most expensive. And he doesn't know. And you tell the people, hey, listen, but we already got bids north of 32, so. And that's, you know, that's where the competition starts. But I don't know if you're experienced, people are not that far apart usually. And people who are that far down don't really want the deal. And for whatever reason they got a bid, or they totally missed something, you know? Or they totally disagreed with the assumptions there. Because either they were overly pessimistic or realistic, right? Maybe somebody said, hey, Office Depot's going to blow out of here, and we're not going to be able to redo this. We don't have the, you know. Or there's a guy that says, hey, I already got Trader Joe's, and they're going to go in here at 50 bucks, and he can be up here, you know. So
yeah, I mean, usually there's the pack of guys who are all at the same number, and there's 2 or 3 guys who are right above that, and then there's one guy who is like way up high, but he's not real. And then the rest of them are just bottom feeders who are just trying to who honestly put in offers on every deal in the hopes that one just goes through.
Yeah, and the guy that's usually overly high doesn't have the money, he's just gonna try to shop that deal to somebody else.
Yes.
He's gonna try to lock it up and then find a greater fool to come in with the money and do it. And, flip a contract or participate in it somehow.
Yeah, and I mean, not knowing where other people is hard, because when you really want a deal, you're willing to not overpay, but pay maybe a higher amount than it's worth. I mean, I've lost deals over $100,000, and we're like, shit, I would have paid that extra $100,000 to buy the deal, but ultimately it's whoever pays the most.
I lost a deal in downtown Orlando that I really wanted. It was a nice office building, it had development rights, and we were the highest bidder. And, ultimately, I blame the broker. The broker was the people at Jones Lang, very nice and all that, but, they somehow, in the phone interviews, they kept twisting, well, but it's 1031 money. How do we know that you're really gonna be able to, dude, we've already closed on our, on our transaction, and the money's at the qualified intermediary. Well, but what if there's any obstacle, and ultimately, somebody else got it, and we were the highest bidder. And again, it was a couple $100,000, and it was a $30-some-odd million deal. But they can justify, as a fiduciary, hey, I know I got certainty to close with this guy, so. A friend of mine just sold a self-storage facility, and ultimately he sold it to somebody because he knew they could close. And he was looking to flip the money into something else, and he needed certainty of closing within a particular time frame. And for him, that meant the world, so. Anything else?
No. Unless you have any questions.
I did have one. Was the interest only just because of the rate you had? You thought the first 2 years it was a good point to lease it up and all pay the interest?
Yeah, I mean, now on stabilized deals, banks are giving ridiculous quotes for IO. I mean, on a development deal I'm doing now, I'm getting IO for the first 2 years. I mean, banks are just being competitive and just wanting to get the money out there at low rates. I mean, if you look at the 10-year and the swaps and everything else, I mean, they're at super low levels. We just financed a multi-family deal, 10-year term with 5 years IO. I mean, just banks are just.
There's 2 points on that.
Yeah.
One, especially development deals, why do you need interest-only periods
Because
or redevelopment deals? Because the asset's not generating the cash flow, right? But in a deal like this, it's stabilized. I guess the question is, do you want the cash in your pocket or do you want to pay the bank? Now, the conservative person in all of us would rather pay off debt, right? And just, be done with it. But if you start playing with numbers here, right? And ultimately, again, I don't know if do you do how much of the IRR is?
We went through to a zero. Oh, that's even much.
No, but what I was going to say, Andrew, what some people will do in their cash flow is say how much of the IRR is driven from current income and how much is from capital appreciation. And on a value plus deal, a significant component of the increase of the IRR is going to be on the value creation somewhere down the line.
Yes.
So if you can increase your current income, the cash you're pulling out in a nearer term, you're going to have a higher overall return. So I'm sure if you play around with it.
Yeah, so what's that? So right now it's at 24 months at 12 and a 2.42x. If we bring that to 0, it's 11, but the cash flow goes up because you're paying off debt in at the beginning.
Right.
So for somebody,
Your unlevered doesn't change. Only your levered changes.
so for somebody who's on a cash or a multiple, they might not want that, versus somebody who's on a IRR, they definitely want that.
Okay. Yes, Frederick.
Question, when it says projected unlevered and leverage, What are they talking about?
Well, yeah, right, so you've come into the program after the investments class was taught. That's kind of like,
Okay.
so yeah, what happens is people have been coming into the program not lockstep, and so they're not following the progression of class. It basically talks to what's the underlying cash flow, assuming there's no debt, and what's the underlying return if there is debt? And you say, well, why would it be higher if there's debt? Well, ultimately, that just goes to the cost of debt being lower than the cost of capital. Stay tuned until you take the investments class, and you'll figure it out. You too, Tyler. You got that, right? It's playing with other people's money.
Yeah.
Using other people's money is going to give you a higher return, because hopefully you're finding other people's money that has a lower cost than yours. Conceptually. Any other questions for Andrew? Okay. Thank you, Andrew. Very, very helpful, very insightful. Let's meet back in an hour at 1 o'clock. Let's say 1 o'clock. 1 o'clock. 1 o'clock, we'll see you here.
Grab some real quick?
Yeah, of course.
You mentioned that you guys, as a company, have particular challenges, so to speak, with different vendors that you know already what they're looking for. Do you guys have like less
Yeah, so we have everything from your local canning salon to Target. We represent Corner Bakery, which is I think what other restaurants.
We're gonna walk over there.
I know we do.
We'll see that national
National restaurants.
fast foodish.
No, no, like fast food. We there's a new sushi spot that's a fast food casual. How you roll. There's a one over here, or how we roll, or roll sushi, or something like that. Represent them. I mean, we're all over the board as far as tenant rep.
You have a business?
Yeah, of course.
Yeah, and if Andrew, if you don't mind,
Actually,
if you
don't have one on.
can
on me.
I share your contact info with the class?
Of course.
So what I'll do is when I send the summary for the weekend, I'll just put your contact information there.
Okay.
Richard,
The reason I ask
you
is,
won?
I'm working with,
How did they look good or no?
over here, that's trying
Our
to
guys.
get their, they have a save a lot. And they-
Okay, okay. So we were,
And a Family Dollar anchored
Okay.
plaza. Obviously, not everybody's trying to be next to us.
I mean,
Yeah.
The areas of food does.
but did you change it?
Find like these local, whether it
Because
be
then they change
hair
it.
salons or like little restaurants, like
I mean,
a sandwich spot. Like a sandwich.
Yeah, I mean stuff like that. We don't really represent. I mean that stuff you're probably gonna find your more one-off mom and pop who want to open up their
Right,
Chinese
right,
food or
right,
whatever.
right, right, right.
I'm assuming based on all those tenants that it's not really. It's not in the best area.
It's not.
Yeah.
Then who was this, Nick? Was this
It's
Nick
actually-
by any chance?
It's gonna be close to where the all aboard Florida stuff.
Yeah, yeah, yeah.
So it's
Okay.
coming up. It's just the market is not there yet.
Okay.
You know, like they not Papa John's. They,
Yeah, the little boy, the little blonde boy.
Jimmy John's.
Yeah, he's pretty good. Pretty
Okay.
boy's pretty good,
Sure.
actually.
We actually represent.
And what about anybody
them.
else or no?
We do all of
The little,
Jimmy John's,
I told you a little
Bowery,
fact kid.
I think Palm Beach too, but
What
not
have you
too.
got in your heart saying?
No, I understand that. I didn't say he was.
You got a lot of, you got a lot
No,
of
but
body
he's not
parts.
horrible.
We have ice cream shop.
Very good, man.
Appreciate it.
We've got ice
Okay,
cream shop.
and what about,
Spoon.
did like Conrado do anything, or not
Not
really,
trying to
or?
use this little spoon, but
Yeah, no, in that area it is
And
tough.
I'm gonna give you a call.
Okay, yeah, for sure. That area, I'm dying to buy just east of the Olive in that Victoria Park. I mean, that was it, Fat Village or something like that. I mean, that area.
And did
I was
any
there on a
of the
Saturday night.
other little kids
It's
show
full
anything, or
of
no? Not really?
residential now. It's filled with these coffee bars and these art galleries. It's almost becoming like a Wynwood.
Yeah, Ballestas.
I think that area next 5 years.
No,
is-
he can
is
only
really
play, the
coming
only
up.
place that kid can play is up top in a disorganized team
Yeah.
running around after the ball.
We'll see. But I appreciate it.
Yeah, man. Of course. Awesome.
Okay. Which one, a little Gersey?